Welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio, period. Today, we are putting Independent Bank Corp, that's ticker INDB, directly under the microscope. They just dropped their Q1 2026 earnings, and, on the surface, these numbers look like they're forged from solid steel. But the market is not buying it. The stock is flat, maybe even down a tick. So the question we are going to answer today, the big one, is this. Is this bank truly built on a foundation of iron, a genuine opportunity to really strengthen your holdings? Or are we just looking at a nice new coat of paint that's hiding some deep structural rust underneath? Let's get our tools out and hammer into the facts.
That's right. And listen, we are not just reading you the headlines today. We're going to run a full-blown stress test. So first up, we're going to dissect that really confusing market signal. Why do strong numbers not seem to be moving the needle at all?
Then I'm going to lay out the bull case for you. We're going to focus on the core strength that's just screaming from the numbers. This is really the heavy lifting of the entire report.
And that's when I'm going to push back. I'll bring the bear case, looking for all those visible cracks that the market might be seeing. We're going to be checking the welds. We're going to be looking for fractures in this story.
From there, we'll break down what management is telling us, their guidance, to see if their blueprint for the future actually holds up under scrutiny.
And finally, you know it, we deliver the Iron Financial verdict. Let's get right to it.
Okay, so let's just dive right into the deep end here. The first thing that you have to understand that you need to wrap your head around is this total disconnect. The earnings report hits the wire, and the numbers, by almost any account, look strong, really strong, and yet the stock barely budges. That right there is a major signal from the market. But what exactly is it signaling? That's the puzzle.
Exactly. This is the whole conflict right here in a nutshell. On one hand, INDB beat revenue estimates. Total revenue came in at about $252.7 million, which was nicely ahead of what everyone was expecting. That should be a green light, right? A reason to celebrate. But after the announcement, the stock actually drifted down a little bit. And when a company posts strong top-line numbers like that, and the market, the entire collective market, just shrugs its shoulders, or even worse, kind of frowns, you have to stop and ask why. What's going on? Is Wall Street seeing something that the bulls are just completely ignoring? Is this one of those moments where you buy the dip because you see a market mispricing? Or is this a big red warning flare telling us all to stay away? And this is precisely why, at Iron Financial, we don't just read you the headlines. We stress test the entire structure from the ground up.
And that's exactly where we start digging. Because believe me, when you look at the fundamental power of this bank's operations, the bull case really starts to build itself, and it looks like it's built on solid ground. The CEO, Jeffrey Tengel, he said their results represent another step forward in driving improved profitability. And when you really dig into the core numbers, he's not just blowing smoke. The engine of this bank is absolutely firing on all cylinders. This isn't about hype. It's about raw, unadulterated earning power.
So the very first pillar of the bull case is this number you see right here, $1.68. Now this isn't just any number, it's the operating earnings per share. And this is absolutely crucial because what it does is it strips out all the one-time noise. In this case, specifically the merger and acquisition costs from that Enterprise Bank Corp deal they did. So what you're left with is the pure, clean measure of the bank's real ability to generate profit from its day-to-day business, the boring stuff, lending money and taking in deposits. It also managed to slightly beat the analyst consensus of $1.66. And let me tell you, in this environment, any beat at all is a sign of serious operational discipline. This tells me the core business isn't just stable, it's performing incredibly efficiently. This is the number that shows you the true strength of the machine.
And this momentum, well, it's not a fluke. It's not a one-off. The data on this slide shows a crystal clear trend. Net income jumped over 6% from just last quarter, landing at nearly $80 million. And diluted EPS, that's the number that actually hits shareholders' pockets, is up more than 7%. That's not just growth, that's acceleration. We are not looking at a company that's just treading water. It's actively forging a path toward higher and higher returns. In a banking sector that is facing, a dozen different headwinds right now, you've got interest rate uncertainty, you've got regulatory pressure, seeing this kind of quarter-over-quarter growth is a real testament to their execution. They are telling a story of building piece by piece, quarter by quarter, and from this angle, the foundation looks absolutely rock solid.
And here it is. This is the engine I was just talking about, net interest margin, or as we call it, NIM. For any bank, this is the holy grail. It is the lifeblood. It's simply the spread between what they earn on all their loans and what they have to pay out on all their deposits. And look at INDB's NIM. It is expanding. It jumped 13 basis points in a single quarter, from 3.77% up to 3.90%. Now you ask, how did they do that? Well, they're getting higher yields on their assets while, and this is the key part, simultaneously decreasing their total deposit costs by 10 basis points. That, right there, is the textbook definition of a well-managed bank. They are widening their profit margin in a very, very tough environment. This is the single most powerful indicator of core profitability you can find, and it's getting stronger, not weaker. This is what funds everything else we're about to talk about.
So, here's the crucial point. What does a company with a strong core and expanding margins do with all that cash it's generating? It gives it back. It returns it to the people who own the company, the shareholders. And in the first quarter alone, INDB went out and repurchased over 800,000 of its own shares for a massive $63.3 million. This is management putting its money where its mouth is, loud and clear. They believe their own stock is a fantastic investment, so they're buying it themselves with the company's money. This action directly increases the value of every single remaining share out there. It's a vote of pure, steel-clad confidence in their own foundation.
And they didn't just stop there, not even close. You see, some companies, they buy back stock. Other companies, they raise dividends. INDB is out here doing both and doing it aggressively. On top of that huge buyback, they announced an 8.5% hike in their quarterly dividend, bringing it up to 64 cents per share. Now, this isn't just some token increase to keep people happy. It is a powerful 1-2 punch of capital return. The buyback says, hey, we think our stock is cheap right now. And the dividend hike says, we are so confident in our future cash flow that we are committing right now to sending more of it directly to your bank account every single quarter. This isn't just about rewarding shareholders today. It is a serious commitment. They are signaling to the market that they expect this level of profitability to continue. So when you combine strong operating earnings, an expanding NIM, aggressive buybacks, and a hefty dividend increase, that's not just a bull case, that's a fortress built of pure cash flow.
A fortress? Or is it a facade? Look, I'll grant you, those are all very impressive headline numbers. You laid it out well. But a fortress, as we all know, is only as strong as its weakest point. When the market completely ignores numbers that look that good on paper, it's because it's looking right past that polished exterior and it's running its own stress test. It's tapping on the walls, looking for the hollow spots, searching for those little hairline fractures. And when you really start applying some pressure to INDB's report, you start to find them. The story, I'm afraid, isn't quite as simple as those big, bold numbers would have you believe.
So let's start with an outside perspective. This isn't just my opinion, okay? This comes from Guru Focus, which runs a pretty sophisticated quantitative analysis on a company's intrinsic value. Their model, which they call the GF value, estimates that INDB's fair price is somewhere around $73.14, but the stock is trading closer to $78 right now. Well, that suggests it's about 7.2% overvalued as we speak. So the very first crack we find is in the price itself. The market might have already baked in all of that good news you talked about, and then some. You're not buying a bargain here. You might be buying at the peak right before a correction down to its fair value.
Okay, now let's look under the hood. Let's look at the actual quality of the assets that are supposed to be generating all this wonderful profit. This slide right here, this is where that narrative of a perfect, shining fortress really begins to crumble. We're looking at non-performing loans, or NPLs. To be clear, these are loans where the borrower has just stopped paying. That's a problem. And look at the trend. Total NPLs jumped from 83.6 million up to 96.6 million in just 3 months. As a percentage of their entire loan book, it went from 0.45% to 0.52%. That is a significant jump. It's a potential leading indicator that credit quality is getting worse. And every single one of these non-performing loans is a direct drag on future earnings. The bank has to set aside more capital just to cover potential losses, and that capital can't be used for anything else. It suffocates profitability. So the foundation might not just have some rust, it could be actively eroding from the inside out.
And here's another crack. It's subtle, but it is very, very important. We're talking about tangible book value per share, or TBVPS. Think of this as the bank's liquidation value. What would be left over for shareholders if they just sold off all their assets and paid off all their debts today? It is the bedrock measure of a bank's structural integrity. And analysts expected it to be $48.34, but INDB, they missed. They came in at $47.86. Now, you might be thinking, well, that's a small miss. It's just under 1%. Who cares? But in banking, let me tell you, missing on your tangible book value is like a builder finding out the concrete mix wasn't quite right for the foundation. It's a fundamental measure of the bank's actual worth, and it fell short of what the experts expected. It's just another sign that things under the surface aren't quite as strong as they appear.
And this just adds another layer to the concern. Because while the profit margins look really good, the core business of any bank is simple. Grow your loans and grow your deposits. If you're not doing that, you're stagnating. It's that simple. And in the first quarter, total loans actually decreased by 0.4%, and total deposits also slipped by 0.1%. So yeah, they're squeezing more profit out of the book they already have, but the book itself is shrinking. A bank that isn't growing is a bank that's at risk of being left behind. You can only cut costs and expand your margins for so long. Eventually, you need real, actual growth. And right now, INDB doesn't have it. This just directly calls into question the entire growth narrative that the bulls are trying to push.
Okay, so you've pointed out some potential stress points. That's fair, I'll give you that. A shrinking loan book and rising NPLs are things we absolutely have to keep a close eye on. So the next logical step here is to look at management's plan. What is their blueprint for the rest of 2026? Does their guidance even acknowledge these issues? And more importantly, do they have a credible plan to fix them? Or are they just crossing their fingers and hoping the market ignores all these cracks you've been highlighting?
So here's the blueprint they laid out for us. They're projecting mid-single-digit growth in their core commercial and industrial loans, C&I, which is where they see their real strength. Now, they do admit that commercial real estate and consumer loans are probably going to be flat, which to me shows they're being cautious and realistic. They expect that net interest margin, their profit engine, will continue to expand throughout the year. And on expenses, they're holding the line, keeping things tight. From where I'm sitting, this looks like a disciplined, achievable plan. They're focusing their growth in their strongest area while managing costs and maximizing profitability. That sounds pretty solid to me. A realistic plan? I'm not so sure. I see a few red flags here. For one, they're guiding to stable asset quality metrics. How on earth can they call it stable when we just saw a significant jump in non-performing loans this quarter? That sounds a lot more like wishful thinking than it does an actual forecast. They're projecting continued NIM expansion, but that relies heavily on interest rates cooperating, which is a huge unknown. And all their loan growth is concentrated in just one area. What happens if their C&I lending falters for some reason? Their entire growth plan for the whole year goes right up in smoke. To me, this guidance feels a lot more fragile than it does fortified.
All right, we've laid out both sides of the coin. We've examined the core strength, and we have stress-tested all the visible cracks. We've gone back and forth on the forward guidance. So now it is time to put it all together. Every single investment decision you make comes down to this: weighing the bull case against the bear case. So, is Independent Bank Corp an opportunity to build on, or is it a trap just waiting for an unwary investor to step in?
So let's put it all on the scales and see how it balances. The bull case is incredibly powerful and it's crystal clear. It's built on the bedrock of strong, even accelerating earnings growth. It's being powered by an expanding net interest margin, which shows incredible operational efficiency. And it's all reinforced by management's super aggressive capital return policy. We're talking huge buybacks and a strong dividend hike. This is the exact profile of a confident, high-performing company that's busy rewarding its owners. But that other side of the scale is heavy too. You can't ignore it. The bear case is built entirely on caution. It points to that undeniable, factual rise in non-performing loans, a clear sign of potential decay. It's supported by external analysis that suggests the stock is already overvalued, and it's anchored by two really fundamental weaknesses. They missed their tangible book value estimate, and their core loan and deposit books are actually shrinking, not growing. This is the profile of a company that might be running on fumes, just squeezing out the last drops of profit while the underlying structure shows some very real signs of strain.
So there you have it, the complete analysis. We've hammered on the numbers, we've pressure tested the asset quality, and we have laid out both arguments, side by side. On one hand, you've got a profitable machine that is returning a massive amount of value to its shareholders. And on the other hand, you've got some very loud warning signs of credit decay and a stagnating core business, all at a price that might already be too high for what you're getting. Here at Iron Financial, our job is to give you the blueprint and the tools you need to make an informed decision. We've stress-tested the structure of INDB for you, but the ultimate choice, whether this bank is strong enough to be a cornerstone of your portfolio or if it's a risk you'd rather avoid, well, that rests with you. You have to decide if that foundation of iron is worth the risk of what could be hidden rust. Thanks for joining us here at Iron Financial. Stay sharp and forge ahead.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.